Hi, my name's Damien Bowie. I'm the portfolio strategist working in the WAM Income Maximiser, ticker WMX. WAM Income Maximiser is a relatively new fund that invests across equity and debt. It is designed to basically deliver you a dividend income which is at least 2.5% above the RBA cash rate while also generating capital growth. What I want to share with you today are three things about the fund. Firstly, despite extraordinary uncertainty, it is actually going very well. We are outperforming benchmark, and most importantly, we are providing that dependable stream of returns and income that investors need during uncertain times. The second point is that we are doing this by effectively coding the macro cycle and the uncertainty that people feel so that we can generate investment insights that are robust and consistent across different investment universes. Thirdly, we feel that we are able to decompose risk and understand the investment universe through a different lens or a series of different lenses. And what this shows us is that investing is complex, but we are actually able to do this effectively on behalf of the retail investor. So on the first point, investing in uncertain times. The first chart shows you our measure of uncertainty. And as you can see, after Liberation Day, uncertainty has gone off the charts. It has since settled back down, but nevertheless remained very high. The right-hand set of charts shows you how the Income Maximiser has performed relative to its own benchmark. And we're pleased to say that it actually has outperformed by about 1.5% since we reached full deployment of the capital. Now, we've obviously done this through active management, but I want to highlight how consistent and stable the returns have actually been. Importantly, we are now generating a running yield on the portfolio, i.e. the interest and dividend income that we are earning from the underlying securities. The weighted average of that is about 4.6%. And on top of that, we have profit and capital reserves that are equivalent to about 4.7% of the net tangible assets of the company. So we are very much on track to deliver you the dividend guidance given before. Now, how are we doing this? Well, we are doing this by basically codifying a lot of the macro cycle and the uncertainty that people feel. So I've given a little illustration here as to how we do this, going from the debt side of the portfolio through to the equity side. It's one way that we do this among many. So what I've got on the two left-hand charts are some charts about interest rates and where we think they are likely to go in the near term across different horizons. So the top left-hand chart shows you where we think short-term interest rates are going to go. That is, if I look out over the next 3 years, where do I think the interest rate should be? The second chart on the bottom shows you where longer-term interest rates are likely to gravitate to. The top chart is basically telling us that short-term interest rates are too low. Whereas the market is convinced that the RBA will keep cutting rates, we are of the view that actually the economy is likely to recover very strongly, that inflation is likely to be very sticky, and as a result of that, we are very fast approaching the point where there is two-way risk to interest rates, up and down, and that deserves a higher short-term bond yield. On the longer-term perspective, most people regard the neutral rate for the economy to be between 3 to maybe 3.6%. That's quite a bit below the current bond yield, which is above 4. So you can see here that short-term interest rates are likely to rise, longer-term interest rates are either likely to stay flat or fall. But we are in what we call a bear flattening regime, where short-term interest rates rise more than long-term interest rates do. The table on the right-hand panel shows you how we would position historically for such an environment. It's called a bear flattener, and in the bear flattening environment, what you tend to see are that mining stocks do very well. On the flip side, the stocks that don't do very well are typically more defensive exposures, such as consumer staples or healthcare. The bottom chart there, the pie chart, shows you how we've currently positioned our equity portfolio, and it is at least a quarter made up of resources stocks. We are overweight. We do look at risk in a number of different ways, and the next set of charts basically shows you the different dimensions of risk that investors are actually taking when they buy any security. Are we buying something which is commodity exposed? Are we buying something which is more credit exposed? High quality, low quality type borrowers? Are we making a duration decision? That is, are we taking a view about interest rates, short term or long term? Are we taking on too much equity risk in terms of, are equities too expensive or cheap, or are different sleeves of the equity universe likely to do well or poorly? So, for example, some investors are momentum investors, where they'll just follow the trend. Other investors are value investors, where basically they'll take a contrarian view and say that the future is anchored and that the valuations need to gravitate towards that anchor point. A third lot of investors actually don't care about the valuation starting point. They're much more just interested in the longer-term growth profile of a stock, the growth investor. And then the fourth investor is the quality investor, who's basically concerned about what could go wrong in the future, the hiccups that could be there on the journey. So they buy companies with higher profitability, payout safety, or growth. So these are the different dimensions of risk that we look at the world through. And what we can identify right now is that taking on commodity exposure is more likely to give you the best reward to risk than to look at those really defensive quality companies. We have a number of signals that have obviously gone into this, but it's very consistent with the analysis that we presented earlier, translating interest rate views through to stock selection. Now, the reason why we say this is simply to point out that investing is complicated. We do need a sophisticated set of tools to be able to view the world and implement our recommendations. And so we think that this is something that is very hard to do at an individual level. It's hard to replicate. And this is one of the key strengths of WMX, that it does strive to give you diversified sources of outperformance. Thanks very much for your time.